You'll need to know this moving forward as the US stock market shows signs of an imminent correction. There's a question on everyone's mind. Is all you can do just wait for that market correction to happen? Or is there a more active role that an investor can take? Well, to tackle a question like this, we need to salvage some wisdom from Warren Buffett before I show you some interesting fundamentals of the market as we see them, especially with things like index funds and dollar cost averaging. Obviously, this is not financial advice, but subscribe to the channel for more discussions like this, and let's get into it.
1942, when I bought my first stock, as an illustration of all the things that have happened since 1942. We've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars. We had 9/11. We had the Cuban Missile Crisis. We have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore. Just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amount to, and it would come to $51 million now. And the only thing you had to really believe in then is that America would win the war and that America would progress as it has ever since 1776, and that American business, if America moved forward, American business would move forward.
And here's what's most interesting. That advice of passive long-term investment into something like an index fund almost frees you from concerns of whether the stock market is overvalued or undervalued. And before I tell you more about it, I think there's worth taking a deeper look at the state of the current stock market indices, since it could tell us what to expect. For one, the clearest sign of an overvalued stock market is gauged from something called the PE ratio, or the price to earnings ratio. Simply put, it tells prospective investors how much money other investors are willing to pay to get a yield of $1. The higher this ratio, the higher the investors are willing to pay in the stock market for the same return. And then all it takes is a glance at the fundamentals of a company, the stock market, and the state of the economy at large to understand whether that's being driven more by fundamentals or just by hype and speculation. For an index fund like the S&P 500, the PE ratio has been on consistent rise for the past year, now standing at 27.45. That's up from 19 just 2 years ago, signaling an upward trend that doesn't seem to be justified given the state of the market and the economy. Then there's also another marker for whether the market is overvalued, and that's the Buffett Indicator created by Warren Buffett himself as a simpler measure. It simply takes the total market capitalization of all publicly traded stocks and finds their ratio with the country's GDP at large. A ratio of below 75% means the market is undervalued, 75 to 90% means the market is fairly valued, and anything over 90% signals overvaluation. Guess what number it is right now? 195%. So how do you go about investing in a market like this when you don't know if all the investment you put in goes down immediately when the market makes a correction? Well, Charlie Munger, who's Warren Buffett's long-term business partner and vice president of Berkshire Hathaway, gave a pretty simple formula for someone looking to invest in index funds, even in a market that seems overvalued.
We have to have a business with some intrinsic characteristics that give it a durable competitive advantage. And then, of course, we would vastly prefer a management in place with a lot of integrity and talent. And finally, no matter how wonderful it is, it's not worth an infinite price. So we have to have a price that makes sense and gives a margin of safety considering the natural vicissitudes of life. That's a very simple set of ideas.
Simple, yet they require one thing that not a lot of investors have, and that's patience. Index funds almost by definition are a long-term game, and that inevitably means they are going to massive slumps, market overvaluation, bubbles, speculation, fear of recession, and market corrections. Getting too caught up in the daily headlines and trying to time and game the market means you've ended up in a confusing gray area between active and passive investing, and that's almost never ending well. Like the turtle against the rabbit, it's better to take your hands off and trust the process after a while, and all that requires is a degree of trust in the greater economy of the country to do that. Sure, that rising tide of the stock market may be slow, but at least it doesn't require you to battle the turbulent waves of active investing.
So I would pick a broad index, but I wouldn't toss a chunk in at any one time. I would do it over a period of time, because the very nature of index funds is that you are saying, I think America's business is going to do reasonably well over a long period of time, but I don't know enough to pick the winners and I don't know enough to pick the winning times. There's nothing wrong with that. I don't know enough to pick the winning times. Occasionally I think I know enough to pick a winner, but not very often. And I certainly can't pick winners by going down through the whole list and saying this is a winner and this isn't, and so on. So the important thing to do, if you have an overall feeling that business is a reasonable place to have your money over a long period of time, is to invest over a long period of time and not make any bet implicitly by putting a big chunk in at a given time.
And that's why a more passive approach to investing in an index fund is often recommended to most people, including new entrants, and one of the best ways to do that is something dollar cost averaging. Sounds like a complicated term until you realize that this strategy is really just there to take the stress out of investing for most people. The idea is simple. Instead of setting yourself a goal of buying a certain number of stocks per month, dedicate a set amount of money to invest each month. Let's say you invest $100 a month. Dollar cost averaging means you invest that amount no matter if it buys you 1 stock or 100 stocks. And that's without even worrying about abrupt market dips or rises. Over a long period of time, the gains start to compound and outweigh the smaller losses along the way, assuming that the economy at large is healthy and growing. And both the market and economy have shown to be resilient when you zoom out into the big picture. For people that still prefer to keep an eye on what index fund investments are doing, what he said about interest rates here in the analogy to gravity starts to make perfect sense.
Janet Yellen has talked a couple of times about the reduced carrying cost of the debt. I think in the last fiscal quarter, the U.S. Treasury, which the U.S. government, which owes a few trillion dollars, I should say, a few trillion dollars more than a year ago, their interest expense was down 8%. So you've had this incredible reduction in the so-called super risk-free group, the short-term Treasury bill. And that is the yardstick against which other values are measured. I mean, if I could reduce gravity's pull by about 80%, I mean, I'd be in the Tokyo Olympics jumping. And essentially, if interest rates were 10%, valuations are much of it. So you've had this incredible change in the valuation of everything that produces money, because the risk-free rate produces really short enough right now, nothing.
The Fed's interest rates are one of the greatest levers that the central bank has to influence consumer spending, borrowing, and in turn impacting stock prices. Higher interest rates disincentivizes companies and individuals from taking on credit, which leads to lower spending, which results in lower profits and a downward pressure on stock prices. And then it works in reverse when the interest rates drop. The interest rate after the last hike now stands at 5.5%. Which is the highest it has been in 22 years. That is likely to impact the stock market, and many are expecting a drop as the spending and borrowing decreases and the hype of AI and tech stocks start to wane. Let me know in the comments how you see it all panning out in the next few months, because investing in an overhauled market like this is probably going to take more patience and trust than it usually required.